Moving on to the next three. So the fourth one, you buy 800 flyers for a total of $96 and pay with a credit card. So notice that that's a transaction. So the fact that we're paying with a credit card, we know that our liabilities are going up by $96. And as I mentioned, any credit card payments, they're going to go under the accounts payable. Now you can adjust this according to what your prof or teacher wants. So if they want you to have an account called credit card debt, you can adjust this. But as I mentioned for this video, any credit card purchases, we're going to put under that current liability account of accounts payable. Now notice that what are we receiving? We're receiving the flyers. And we haven't used them yet. We're going to use them in the future. They get used once they get distributed. And when they're being used at that moment in that period, then it becomes an expense. But at this point here, for this transaction, we just received them and they're going to be used in the future. And so our assets go up by 96. Now you can call this asset account, you could put flyers here. I'm actually going to put a different name for this. I'm going to call it something called prepaid advertising. Which is a type of prepaid expense, and we're going to go into more detail with prepaid expenses in a future video. But prepaid advertising is a type of asset. And it doesn't just have to be flyers. Another example could be like a TV ad that you're going to run. So let's say it's like, let's say it's Monday. And then you purchase a TV ad that's going to run on Thursday. Right? When you purchase that TV ad, that is an asset on Monday. And that would be prepaid advertising. And then once that ad runs on Thursday, then it becomes an expense, an advertising expense. Then this would flip to an expense. Another example is maybe a newspaper, right? So on Monday, you pay the newspaper company, the provider, for an ad that's going to run on Thursday. So when you pay for it on Monday, it becomes an asset. It's prepaid advertising. Right? So if you were to sell your company on Monday, then that would be an asset that's on the books. You would include that in the price of your company. Right? That's an asset that's owned, that's going to be used in the future. And then once it runs on Thursday, once the ad goes in the paper on Thursday, then it would become an expense. Right? So those are two other examples of prepaid advertising. Prepaid advertising is a type of asset. So that's the account I'm going to use for that. And this is it for transaction 4. Notice that it's balancing out. We got 96 on the left side. Remember, the equal sign is over here. So the left side is this, and all of this is the right side. Notice that it's balancing out. And then number 5, it says you purchase $600 worth of cleaning supplies and pay with credit card. So again, $600 goes up in liabilities. That's going to be accounts payable. And then what's going to go up here? Well, we're receiving assets. These supplies haven't been used yet. They're going to be used in the future. So they get recorded as assets, $600. And I'm just going to call this supplies. And you could go into more detail if you want. You can maybe call this cleaning supplies. So sometimes there's different types of supplies. Let's say that this company, you want to wear a uniform. So then when you're buying uniforms from a supplier, that could go under uniform supplies, and then these would be cleaning supplies. But I'm just going to keep it general under supplies for now. So this would be transaction 5, 600, and then 600. And then for number 6, what happens is you distribute 300 of the flyers. And when you distribute the flyers, what does that mean? They're being used now in this period, meaning that that's going to be an expense. So what happened was we have this prepaid advertising asset. And that consists of 800 flyers. And it's worth $96. And so what happens now is 300 flyers get used. And so because 300 of the flyers are being used, that is an expense that's being incurred in this period. But what's the value of that expense going to be? Well, 300 of the 800 flyers are being used, and we know that the 800 flyers had a value, a total value of 96. So we would just proportion it out. 300 over 800, that's like 3 over 8. That simplifies to 3 over 8, and then 3 over 8 times 96 would give us $36. Right, so $36 of those flyers are being used, and that would be an expense, meaning that there's $500, or 500 flyers rather, left as assets, as that prepaid advertising, and the value of those, 5/8 of 96 would be $60. So we would still have $60 left of that prepaid advertising asset. But now 36 of it is going to be an expense. So the transaction for that, or how we input that transaction, the prepaid advertising is going down by $36. Prepaid advertising. That asset account is going down by 36, and then there's going to be an expense. So this would be plus 36. And this would be an advertising, let's call it an advertising expense. Like that. And notice that there's a minus here, so we know that anything in this column here is subtracting. And so notice that it balances out. We got a minus 36 here, and then a minus 36 on the right side. Right? So these three transactions, that's how they are inputted. Now moving on to 7 and 8. So number 7 says, based on the amount of demand that you see from the responses to your advertising, you decide to charge $60 per hour for your service. So notice in this particular description, there is a dollar amount that's given. You're going to be charging $60 per hour. But notice that there's no exchange that's happened. So it doesn't say how many hours of service that you provided, or that you even provided a service yet at this point, at the point of number 7. And so this event is not realized. There's no exchange that happens, and so that's actually not a transaction, so it doesn't get inputted in the accounting system. It's just saying that you're going to be charging that much for providing that service in the future, but that service hasn't been provided yet. However, in number 8, it says in the first month you provide 100 hours of service and get paid in cash. However, 15% of the sales are outstanding invoices to be paid next month. Right? So here, the service was actually provided, and then you're receiving something in exchange. So 100 hours of service is provided, and you're charging $60 per hour. So if you multiply those, that would be $6,000 of revenue that you're getting. And there's different kinds of revenue. The two most common types of revenue are service revenue, which would be this, a home cleaning, and then sales revenue. And that's when there's an actual physical good involved, which is not happening in this kind of business. This business is a service type of business. So you can start getting into a little bit more detail with the revenue. So this $6,000, I'm going to call it service revenue. Now, if you were selling a physical product, let's say your company was selling clothes, for example, then it would be sales revenue. Right? So 6,000 of revenue you realized, right? You provided that service. So 6,000 of revenue is inputted in the system. And then it says you get paid in cash. However, 15% of the sales are outstanding invoices. So bringing revenue back. In exchange for the revenue, just in general, there's two things that can happen. Either you're receiving from the customer another asset, and the most common type of asset is cash, or you provided that revenue, you provided that service, you realized that revenue, and you provided the service, and instead of receiving something, you provided on credit, right? And so when someone purchases a good or service from you on credit, that's called an accounts receivable. And so that's when people owe you money or owe you some kind of asset for that service that you provided. And that's a type of asset here. So when you owe money, it's an accounts payable. But when someone owes you money, it's an accounts receivable. And this is a type of asset. And so what happened was 6,000 of this revenue, 15% of it were outstanding invoices to be paid next month, meaning that this service was purchased on credit. And so 15% of this 6,000 is an accounts receivable. So 15% of 6,000 would be $900. And then the rest you're paid in cash. So the difference would be 5,100. Right? So there's two asset accounts that are being affected here. So 5,100 you get of cash, and then 900 you're going to get the cash next month, but they still owe you, so that there is an accounts receivable, like that. Right? Notice that it balances out. We got 6,000 plus 6,000 on the right side of the revenue. And then if you add these up, it's 6,000. It's just split up into two different asset classes, two different asset accounts. Now, you got to be careful. What are we missing here from this transaction? Well, if you remember, we hired a cleaning lady to help us out. And it said that she's going to help you out with every home. If you remember, it said we're going to pay her $20 per hour in cash. So she's helping you out with every home, meaning that she was present for these 100 hours of service. She was helping you out, and you have to pay her. So it would be, how much do you have to pay her? Well, 20 times 100, so you pay her $2,000, and you're paying her in cash. And so for that part, your cash account would go down by $2,000. And notice that the service has been provided, and so you incur this expense. And this here, it's a wage that you're paying someone, so we could call it a wage expense. And so over here, we would have a $2,000 wage expense. Or you might see something like salary expense. I'm going to call it a wage expense. And then notice, because it's a minus, we're minusing all the expenses. This would be a minus overall as well to this whole right side. So we got minus 2,000 and then minus 2,000 right there. So it's a little tricky. We had to take that event that was given earlier in the example, and then we have to incorporate it within this transaction. So you got to be really conscious when you are reading these questions. Make sure that you see the full picture. Right? So we got 6,000, 6,000, minus 2,000, and then minus 2,000.